Let's get to 1,000 subscribers. Please help support Joni and our team by subscribing and turning on notifications. Hey everyone, Joy here, and wow, do I have some juicy stories for you today. We're living through some seriously wild times in the tech world and US financial markets right now. It's like someone put the entire industry in a blender, hit the chaos button, and now we're all just watching to see what smoothie comes out the other end. So we've got everything happening at once. Apple's iPhone 17 launch that somehow managed to disappoint everyone, some serious political drama between Trump and the Fed, Oracle absolutely crushing it while Synopsys crashes and burns, and meanwhile, the stock market is partying like it's 1999. Oh, and everyone's betting on interest rate cuts like they're placing bets on their favorite sports team. These events are basically showing us that we're in a major shift. Investors need to completely rethink their strategies. It's like when your favorite restaurant suddenly changes their entire menu and you're standing there going, wait, where's my usual order? Time to adapt, people. Joy Up Invest Podcast. Invest better every day. Hello, dear listeners, and welcome to Wall Street Wake Up, the show that wraps up and updates you on what's been happening in the U.S. stock market and markets around the world over the past 24 hours. Let me start with the market party that's been going on. While Apple was having its little crisis, the overall U.S. stock market decided to throw the biggest celebration ever. The Dow Jones, S&P 500, and NASDAQ all hit record highs, like they're competing in some sort of who can reach the sky first contest. And why is everyone so happy? Well, it's all about the Fed potentially cutting interest rates. Think of it like this. When your parents are stressed about money, they're stricter with your allowance. But when they're feeling generous, suddenly you get extra cash for that thing you wanted. The Fed is like the parent of the economy. And right now, the economy isn't doing so great. Get this. Employment data showed that job numbers were revised down by 911,000 positions over the past year. That sounds terrible for regular people. But for the stock market, it's like Christmas morning. Because bad employment news means the Fed will probably cut rates to help the economy. Traders are betting there's a full chance of at least a 25 basis point cut next week, and some are even hoping for an aggressive 50 basis point cut. For long-term investors, this lower interest rate environment is like getting a discount coupon for growth stocks. When borrowing money gets cheaper, companies can invest more, and high-growth tech stocks become more attractive. It's basically like your favorite online store having a sale. Suddenly, everything looks more appealing. But here's where things get spicy. We've got some serious political drama brewing between President Trump and the Federal Reserve. Trump tried to fire Lisa Cook, a Fed governor, but got slapped with a temporary restraining order from the courts. This is like trying to fire your roommate because you don't like their music taste, but then the landlord steps in and says, "Hold up, you can't just do that." This matters way more than you might think. The Fed is supposed to be independent. They make monetary policy decisions based on economics, not politics. Lisa Cook is the first Black woman to serve on the Fed's board, and she was appointed by Biden with a term that extends beyond Trump's second presidency. Trump's using some housing fraud allegations as his reason, but honestly, the timing seems pretty suspicious. If this case goes to the Supreme Court and Trump wins, it could open the door for future presidents to interfere with Fed policy whenever they feel like it. That would be like letting the coach of your favorite team also be the referee. Not exactly fair, right? Markets hate uncertainty, and they really hate it when the independence of central banking gets threatened. Now let's talk about the tale of two very different companies, Oracle and Synopsys. This is like watching a movie where one character gets the fairy tale ending, while the other one, well, let's just say it doesn't end well. Oracle absolutely killed it this week. Their stock jumped over 28% after reporting earnings that made everyone's jaw drop. Their multi-cloud database revenue grew by an insane 1,529%. I mean, that's not a typo, 1,529%. It's like a small coffee shop suddenly becoming Starbucks overnight. They're predicting Oracle Cloud infrastructure will grow 77% to $18 billion this year, and then explode to $144 billion within 4 years. That's the kind of growth that makes investors do happy dances in their living rooms. Oracle's success is also boosting other tech stocks like Nvidia and AMD because everyone needs more chips to power all this AI infrastructure. It's like when a trendy restaurant opens in your neighborhood, suddenly all the shops around it start doing better too. But then we have Synopsys, and oh boy, what a different story. They reported earnings per share of $3.39 when analysts were expecting $3.80. That's like studying for an A, but getting a C+ instead. Technically passing, but definitely not what anyone wanted to see. They also gave weak guidance for the next quarter, which is like telling everyone, yeah, things aren't going to get better anytime soon. The main problem? US restrictions on exporting chip-making equipment to China. Even though those restrictions were lifted in July, the damage was already done. It's like when you have a fight with your best friend. Even after you make up, things feel awkward for a while. This brings us to Apple's big announcement, the iPhone 17 launch. Now, Apple called this their biggest change since the iPhone 6 back in 2014. They introduced the iPhone Air with an ultra-thin titanium design and the iPhone 17 with 48-megapixel fusion cameras on both front and back. Sounds pretty cool, right? Well, the market didn't think so. Apple stock dropped 1.5% immediately after the announcement. It's like preparing the perfect surprise party for your friend, but when they walk in, they're like, "Oh, thanks, but I was kind of hoping for something different." Here's the real problem that has investors worried. Apple is partnering with Google for AI instead of developing their own Siri technology. Link's equity strategies pointed out that Apple might be essentially giving up and using Google's AI models instead of building their own. Think about it this way. Imagine you're a famous chef known for your secret recipes, but then you start using your competitors' ingredients and techniques. Your customers might start wondering, why am I paying premium prices when I can get similar food from the other guy for less? There are also concerns about the A19 chip performance potentially falling behind competitors like Qualcomm and MediaTek. For the first time ever, Apple didn't improve their chip design, which might signal that their technological leadership is weakening. If Android phones can offer similar AI experiences, how will Apple justify their premium pricing? The partnership with Google creates another problem. Google will have more bargaining power and might demand higher fees or data sharing from Apple. It's like being dependent on your rival for the most important part of your business. Not exactly a position of strength.
So what does all this mean for us regular investors? Well, we're seeing a major structural shift in the tech industry. Oracle, which many people considered old school, is absolutely thriving in the AI era. Meanwhile, Apple, the company we thought was untouchable, is facing real challenges in maintaining their innovation leadership. The lesson here is that investing in this era requires looking beyond brand names and past success. You need to focus on companies that can truly adapt and leverage AI technology, not just slap an AI-powered sticker on their existing products. For portfolio allocation, investors might want to consider increasing their weights in cloud infrastructure and AI enabler stocks. At the same time, be careful with companies that depend heavily on international trade, especially anything China-related, because trade policies can change faster than fashion trends. Also, keep a close eye on political developments that might affect Fed independence. If central bank autonomy gets compromised, it could shake market confidence in the long term. Markets like predictability. They don't like it when the rules of the game keep changing. Here's the thing about this AI transformation. It's not enough to just use someone else's AI technology anymore. Companies that can create their own AI capabilities and differentiate through genuine technological innovation will have the long-term advantage. Companies that depend on external partners for core technology might face risks in bargaining power and control. It's like the difference between a restaurant that has its own secret recipes versus one that just reheats frozen meals. Both might taste okay today, but only one has the ability to truly innovate and control their destiny. The current environment also presents interesting opportunities. Lower interest rates should benefit tech stocks overall by reducing capital costs and making growth stocks more attractive. But investors need to be selective. Not all tech companies are created equal in this new AI-driven world. Look for companies with genuine AI capabilities, strong cloud infrastructure, and the ability to adapt quickly to changing market conditions. Avoid companies that are too dependent on external partners for critical technologies or those heavily exposed to geopolitical tensions.
Let me wrap this all up for you. This week's events are telling us that the tech world is changing faster than ever. Apple, which we thought was unshakable, is showing cracks in its armor. Oracle, which many dismissed as old news, has become the star of the show. The overall stock market remains strong, on hopes of rate cuts, but we need to watch out for political uncertainty that could disrupt everything. Investing in this era means looking deeper than company size or past reputation. You need to identify who's truly adapting, who has their own technology, and who isn't overly dependent on others. Most importantly, diversify your risks. Don't put all your eggs in one basket, no matter how shiny that basket looks. And don't forget to keep an eye on political developments, because they impact markets more than most people realize. Whether the Fed cuts rates, whether Trump can interfere with Fed independence, these factors will shape market direction for years to come. The bottom line is this. In a world changing this fast, survival goes to the most adaptable, not necessarily the strongest. Companies and investors who can pivot quickly and embrace genuine innovation will thrive. Those who rely on past glory or superficial changes might find themselves left behind. That's all for today, folks. Hope this was helpful and not too overwhelming. Remember, in times of uncertainty, knowledge is your best friend, and staying flexible is your superpower. Until next time, keep learning, keep adapting, and happy investing. All of this is just my personal view. It's not investment advice. Please use your own judgment and do thorough research before making a decision, because all investments have risks. Before we say goodbye today, if you're a stock trader and you have questions but don't know who to ask, feel free to leave a comment and we can chat. See you next time. Bye-bye.